Welcome to the Deep Dive. Ever feel like you're drowning in financial news, just wanting someone to cut through the noise and get to the heart of the story? If that sounds like you, you're definitely in the right place. Today, we're doing a special deep dive into a really interesting company, Lemonade. You know, the AI-driven online insurer, ticker LMND. We're looking at where it might be heading.
Yeah, and for this, we're leaning heavily on a recent piece from The Motley Fool by Leo Sun. It's called Where Will Lemonade Stock Be in 5 Years? And it gives us a snapshot from around August 24th, 2025. Our goal here is pretty simple. Unpack the key insights from this article. We want you to walk away with a solid understanding of Lemonade's journey, where it stands now, and what the forecasts look like for the next 5 years, both from analysts and the company itself. We'll hit those aha moments, the surprising bits, without getting bogged down in jargon. Honestly, the whole idea of an AI-first insurer is fascinating, and its stock, well, that's been quite the ride. Okay, so let's unpack this. Lemonade really hit the market with a lot of buzz, didn't it?
This tech-forward approach definitely caught people's attention early on. What was the core of that initial excitement?
Yeah, it really did. The initial appeal was Lemonade's bold claim. They were basically saying they could shake up this, historically pretty traditional insurance industry. They positioned themselves as this AI-powered platform making insurance simple. Think chatbots, algorithms, getting a policy or filing a claim instantly.
Right, none of the usual paperwork headaches.
Exactly. And that digital-first approach, it just clicked, especially with younger people and maybe first-time insurance buyers. They wanted efficiency, transparency. It was just such a stark contrast to the old agent-driven way of doing things.
And you could see that in the stock price. It was spectacular early on. IPO'd at $29, right?
Yeah, $29.
And then it just skyrocketed. Hit a record high of $183.26 in early 2021.
Yep.
I mean, that's a huge jump in a really short time. But then, well, the story shifted quite dramatically. After that massive surge, the stock fell off significantly. Now it's trading around, what, $58 as of late August 2025. That kind of reversal makes you ask, what happened? What caused such a big drop?
Well, a lot of it boils down to a shift in the broader market sentiment. Rising interest rates were a huge factor.
Oh, okay, the classic growth stock problem.
Exactly. For companies like Lemonade, valued more on future potential than current profits, higher interest rates just make that future money less valuable today. It deflates valuations. And investors started looking much harder at companies that were still losing money. It wasn't just Lemonade, The market really pulled back from a lot of high-growth, unprofitable tech firms.
People wanted safer bets, companies making money now.
Right. Immediate profitability became much more attractive.
It really feels like Lemonade's journey mirrors what happened in the broader tech market these past few years. Euphoria, then intense scrutiny. Does this whole episode teach us anything bigger about investing in disruptive tech? Beyond just Lemonade, I mean. #tag2. Understanding Lemonade's business model and market position. Okay, so Lemonade started with homeowners and renters insurance. That was a while ago. How has the business evolved? What is Lemonade today?
They've definitely broadened their scope. While homeowners and renters were the start, their platform now covers term life, pet health, and auto insurance, too.
Trying to cover more bases.
It seems strategic, yeah. Trying to capture more of a customer's total insurance needs over time. The acquisition of Metromile back in 2022, for example, that was a big move.
Right. That beefed up their auto insurance side.
Significantly. Auto is a massive market. And their partnership with Chewy, that supports the pet health side, using a known brand to reach pet owners.
So, more products. What about customers? Has the customer base grown along with these new offerings?
Oh, absolutely. Customer numbers are up. End of Q2 2025, they had about 2.69 million customers.
Okay, 2.69 million. How does that compare?
Well, that's more than double the 1 million they had at the end of 2020, so good growth for them. But here's the fascinating part. While that's solid growth for Lemonade, you put it next to an established giant, like, say, Allstate.
Yeah.
Allstate serves over 16 million customers, so Lemonade is still, comparatively small.
Right. It really puts their niche strategy into perspective. They're not trying to be Allstate, at least not yet.
Exactly. They're differentiating with tech, targeting specific groups.
Got it. So that context is key. How do we actually measure their progress then? What are the main financial things, the metrics that people use to judge how Lemonade and insurers in general are doing?
Okay, yeah. There are a few key ones to track. First is in-force premiums, or IFP. Think of that as the total potential annual revenue from all their active policies. It's their footprint.
Okay, potential revenue.
Then there's gross earned premiums, GEP. That's the portion they've actually earned by providing coverage during a period that's closer to recognized revenue.
Earned revenue. Makes sense.
Now, Crucially for insurance, there's the gross loss ratio. That's total claims paid out divided by the GEP. If this number goes over 100%.
That's bad news. Means they're paying out more in claims than they're earning in premiums.
Exactly. Fundamentally unprofitable on the core business. Keeping that well below 100% is vital for getting to profit.
Okay, vital metric. What else?
And finally, adjusted gross margins. This gives you a clearer view of their profitability after direct costs, like claims and reinsurance, are taken out. Shows operational efficiency.
All right, let's dive into the numbers from the source article. They really tell a story, including a pretty significant slowdown period. Like customer growth, it went from 56% in 2020 way down to just 12% in 2023.
Yeah, big drop.
And IFP and GEP growth saw similar declines. Plus, that gross loss ratio we just talked about, it peaked at a concerning 90% in both 2021 and 2022.
The ideal.
And adjusted gross margins dipped too, down to 23-25% in 2022 and 2023.
That's a really important question. The slowdown had a few layers. A big issue was getting approval for higher rates for home and auto policies in several states.
Ah, the regulatory hurdle.
Exactly. Regulators have to approve these things, and delays meant Lemonade couldn't really counter rising inflation with higher prices fast enough. So, without those higher rates, they kind of had to pump the brakes. They approved fewer new policies to avoid taking on risky, unprofitable business, and they cut back on ad spending, too.
So they were basically stuck waiting for approvals.
Pretty much. Waiting for rates to catch up and the regulatory picture to clear up.
But then, looking at the data again, something clearly shifted. There was a significant rebound. Customer growth bounced back to 24% in 2024 and 2025.
Right, a definite uptick.
IFP growth jumped to 29%, GEP to 25%. And on the profit side, the gross loss ratio improved quite a bit, down to 73%.
Much healthier.
And adjusted gross margin recovered to 35%.
Yeah.
So what drove this turnaround? And importantly, how much was it really about their AI?
Well, the turnaround was definitely impressive. A few things clicked into place. Critically, those higher rates they needed. They finally got approved in more places.
Okay, that unlocked things.
It really did. That allowed them to write more policies again and, importantly, feel confident ramping up ad spending to bring in new customers. But here's where the AI part becomes really interesting, the aha moment, if you will. It's about how the tech impacts the bottom line.
Okay.
Think about traditional insurance claims. Lots of people, phone calls, paperwork. It all costs money, eats into margins. Lemonade's AI, though, automates a lot of that. It can spot potential fraud quickly, approve simple claims, sometimes in seconds, often with no human involved.
Wow, okay.
That drastically cuts down what the industry calls loss adjustment expenses.
Okay.
It streamlines everything. That efficiency boost is a huge driver behind those improved gross margins.
So the AI isn't just for show, it's actually cutting costs significantly.
Exactly. It's fundamental to their cost structure, not just a fancy front end.
That is a key difference. But digging in a bit, is this AI advantage something the big traditional guys can just copy easily? Or did Lemonade have something unique, a sustainable edge that keeps them competitive?
That's the million-dollar question, isn't it? Well, yes, the big insurers are definitely investing in AI. Lemonade was built AI first, from the ground up.
So it's baked into their DNA, so to speak.
Pretty much. Their whole system, underwriting, claims, everything revolves around it. That gives them an agility, a cost efficiency that legacy systems, often weighed down by decades of older tech, find hard to match. Their data models are constantly learning, too. Theoretically, that helps them price risk better and better over time. So while others adopt AI, Lemonade's integrated approach, it does seem to give them a distinct edge in operations and customer experience right now.
Okay, so given this turnaround and the AI edge, what does our source material suggest for the next 5 years for Lemonade stock? Where do they see themselves going?
Well, Lemonade itself has put some numbers out there for 2025. They expect in-force premiums, the IFP, to rise 27-28%. Gross earned premiums, GEP, up 24-25%.
It's all growth projections.
Yeah, and overall revenue growth projected at 26%. Now, on profitability, they see adjusted EBITDA improving. Still negative, mind you, but moving from negative $150 million towards negative $135, $140 million.
So loss is narrowing, moving in the right direction.
Exactly.
And what about longer term? I remember reading about an investor day presentation. They had some really ambitious goals.
Oh, yeah, very ambitious. They talked about growing their IFP from around $944 million in 2024 to potentially $10 billion in the coming years.
Wow. $10 billion IFP, that's a massive leap.
It is huge. Plus, they're aiming for adjusted free cash flow to turn positive in 2025, stay in the green, and for adjusted EBITDA itself to finally turn positive in 2026.
Okay, $10 billion IFP, positive EBITDA by 2026. How do they realistically plan to get there? What's the thinking?
It really hinges on that core idea. AI efficiency plus economies of scale. As they grow, the cost per policy managed by their AI system should keep dropping.
So scale makes the tech even more efficient.
That's the theory. Diluting costs, pushing them towards profit. The plan also involves expanding into more U.S. states and adding more insurance products to capture more market share.
You know, looking bigger picture, this isn't just about insurance policies. It's a big bet on whether AI can fundamentally change the economics of a huge traditional industry like insurance.
Right, that's the company's vision. What about outside analysts? Are they buying into this optimistic view?
By and large, yes. Analysts seem pretty positive too. Looking out from 2024 to 2027, the consensus expectation is for revenue to grow at a compound annual growth rate, a CGR, of 45%.
45% CGR, that's strong.
It is. And crucially, they also predict adjusted EBITDA will turn positive by 2027, so aligning somewhat with the company's timeline.
And where does valuation fit in?
Well, currently the stock trades around 4 times the estimate for next year's sales.
Okay, so bringing it back to the article's main question, could the stock actually double? The piece suggests that if Lemonade hits these analyst targets, keeps growing revenue at maybe 20% CGR for 3 more years after 2027, and keeps that 4x sales multiple. Right, if all that holds, the market cap could jump over 150% to around $11.1 billion by 2030.
That's the potential upside scenario. What's the author's confidence level in that?
The author, Leo Sun, seems to think it's achievable. He points to Lemonade's knack for attracting younger customers who are just fed up with the old ways. He argues their AI approach gives them a real, sustainable edge against the giants, even if they hit some growing pains expanding beyond their initial niches.
So the argument is the tech and the target market give them a path, despite the challenges.
That seems to be the core belief, yeah. It lays out the potential upside and the assumptions behind it pretty clearly. Hashtag tag outro.
Wow, quite a journey we've covered there with Lemonade. From that dazzling IPO through the market correction, then leveraging its AI to stage this recent turnaround in growth and margins. And now, these ambitious plans for the next 5 years aiming for major growth and finally hitting profitability. Fundamentally, it feels like Lemonade is betting it can be the modern alternative, using AI to make insurance simpler and maybe capture a whole new generation of customers. If they pull it off, that projected market cap growth could be significant. It's definitely a bold strategy in a very established field.
Absolutely. So, thinking about everything we've discussed, what really stands out to you, the big question to ponder is, how much weight do you give that AI-driven edge Lemonade is trying to build? Is that tech advantage enough to truly disrupt these massive entrenched players in the long run?
And while you're thinking about that, here's one last question to chew on, something to explore on your own perhaps. Looking beyond Lemonade and insurance, what other really traditional industries feel ripe for disruption? Where could technology drastically simplify things for users, even if it means some early losses to gain market share and maybe dominate later on? Where might we see the next Lemonade pop up?